Up next, and I think we'll just transition almost right to it, is Jonathan Ellis, Managing Director at Sandalphon Capital, who is here to talk to us about how to fundraise from out-of-town investors. Jonathan, how's it going?
Doing well. Thanks for having me.
Thank you so much for joining us. I'm going to pass it over to you, and I can't wait to hear what you have in store for us.
That's great. Yeah, well, unfortunately, so for a day focused on conversations, I'm going to stand in a room and talk to myself for 20 minutes. But just pull up some slides here. Here we go. So, thanks for having me. So my name is Jonathan Ellis. I'm actually based in Chicago. So to have a Canadian, I'm the English guy based in Chicago. Quick background on Sandalphon. It's a small fund raised a few years ago. Focused really on the Midwest and sort of underserved markets, so very much in line with your sort of flyover country sort of focus today. Here's an example of some of our portfolio companies here. Not picking my favorites here, but just examples of folks that either were based in Chicago and did a good job raising money from out-of-town investors, or folks that I actually sort of invested in sort of out of town of Chicago. And I'm also the founder of Midwest Tech Connect, which is a virtual summit to connect Midwest-based and Midwest-linked startups with early-stage investors from all over the place. So here we're going to talk about how to raise money from out-of-town investors, just to get everyone on the same page, I guess, in terms of some fundraising fundamentals. To me, fundraising is a competitive sport. So it's not doesn't mean you're sort of competing against your direct competitors. That just means you're really competing for attention from VCs who are trying to juggle time between, other portfolio companies, other ways of spending their time, other things that are landing in their inbox. You're really trying to be sort of the top 10 most interesting thing that they sort of have on their list, and then eventually sort of top 3 and then top 1 to really get deals done. So you always have to put your best foot forward and have to sort of hold yourself to a really high standard. Fundraising is also sales. And by that, I mean that it's you're really selling not just your idea, but also conveying, your execution. You're building confidence in yourself, the team you've built, the product you've built, and you really got to build relationships really from that initial touch point and over time. You also have to make it easy for people to find you if they, if you're an AI company. Make sure that AI is plastered all over your website, all over social, so investors that are using an outbound strategy can find you because you're within sort of their thesis. Make it easy to understand what you're doing. Make it obvious, like why what you're doing is interesting. That comes sort of down to your pitch deck, and conveying, sort of the early sort of traction you've got, the market opportunity in front of you. And I also about building confidence over time. That first meeting, people might find your idea interesting, but you're not going to get a yes straight away. You have to build that over time by showing sort of sustained progress and build a stronger relationship over time. You also have to be patient, be methodical, be organized. You're going to have multiple parties involved. Everyone will be at different stages. Everyone's going to need sort of different next steps, follow-ups. So allow a lot of time for the fundraising process, and sort of just try and keep on top of all the moving pieces. Otherwise it can get a little bit chaotic, and you start not getting back to people. You start not giving people the follow-ups, and that creates a sort of a bad impression. And really, you just got to stand out from the crowd. You've got to be, one of the most interesting things people are looking at. So this presentation is actually a cut down version of a longer one than I did. I'll give you a link to the longer version at the end. But before you even get into the fundraising process, there's certain things you can do to prepare to make your fundraising process go smoothly. The only one I'll really touch on today is the prospect list, and how to sort of build that, given, how do you identify out-of-town investors. But having a good CRM, so you're tracking, where you are with people, whether you've got to a decision maker yet, what are the outstanding items, what is the expected timing for everyone. That's all important. Pitch deck is a presentation in and of itself, as is the data room and the pitch and what you need in there. Other sales materials, if you're recording a demo of your product, things like that. So there's lots of things which you can do to prepare and sort of come out swinging when you start your fundraising. So building the prospect list, though, this is like not a simple process. It's not something you can just do in an hour. Some people will spend a whole weekend working on this. Share a Google Doc and pull in other people to sort of add suggestions. But there are databases out there like PitchBook or Crunchbase or AngelList which might get you started on finding people who have invested in comparable things previously Doesn't tell you what they're interested in going forward necessarily, and not everything's tagged appropriately. But using Twitter, using Google, using LinkedIn, keywords, you can really build up like the list of not just the funds, but also the individual partners or associates that are focused on your sector to really sort of build like a high, more of a sort of qualified lead list versus just a list of funds to go after. I think conferences and events, obviously there's fewer of them happening, but they're still happening virtually. Seeing who's speaking at the events is good, because that's going to give you, if they're speaking at an AI event, then that suggests they are sort of an expert in AI or certainly focused on the area. And equally attendees, like getting the attendee list, using the sort of conference networking type functionality. You can again use these things to build lists of people who are sort of focused on your space. And then probably the thing which I think is probably the most powerful, if you already have some investors, they'll probably have some recommendations from their network, but don't go it alone. You should hopefully be building a network of other founders, peers to sort of like ask for advice, perhaps mentors, people who have been further down the field than you. Ask them for recommendations as well. Don't necessarily reinvent the wheel. Service providers are also pretty sort of plugged in with the world of investors. So that could be banks, lenders, lawyers, recruiters, you name it. Insurance brokers even. So ask all these people, especially as you get out of sort of your local area. People who are regionally focused or people that have been showing up. These are all people that you can sort of add to your list beyond just the like low-hanging sort of local people that you perhaps know personally because you're in a relatively small market. And then the other thing I think is underestimated, as you go, if you have a conversation with investors and it's not a fit, ask them if they can think of anyone else. Now, that's not always going to work well, because if they've passed, then that's not a high signal referral. But if they are, if it's not a fit because you're out of sector or you're out of stage, you're too early, then actually that intro is still pretty good. And I've actually invested in a few companies where another fund, in one case passed, in other cases it was just too early for them. Send me a deal, and I actually invested. So these are all sort of different things you can do. Build a list initially. I'd suggest starting with like 100. Reach out, and just keep refining over time, honing in on sort of who's a good fit. And I guess one thing I'd like to touch on here is just the fact that you're really competing. Again, to talk about the competition thing, you're really competing for attention. So there are hundreds or thousands of startups out there, depending on the investors' sort of sector, geography focus, and they might be having an outbound strategy, sort of proactively reaching out to people. They might be getting a lot of inbound, and then they're getting referrals. So you've got to sort of fight to find a really good way in that's going to sort of help get you on the radar in a sort of high intent way. And your job with any sort of initial intro, or if you do a cold outreach, it's getting them to open your deck, getting a first meeting. You're not trying to get them all the way there straight away, but get that first meeting. The goal of the first meeting is just to get a follow-up meeting. And once you get the follow-up meeting, you've sort of started to get to know each other. You've been, probably started to like identify some issues that they want to dig in on further. Then you can start working through the diligence, and like moving into diligence is in itself like a whole sort of new hurdle to reach through. But just think of it through phases, where ultimately, as you're going through, you're driving everyone to close. So the process I always think of is, it's an old sales reference, but AIDA, attention, interest, decision, action. This is Glenn Ross, if you've seen it. And so for attention, I always think about the approach, how you're getting in front of them to get their attention. And then you have to generate interest and assess interest over time to understand really where you should be spending your time to, convert people. The decision, or I think sometimes in AIDA they say desire, but that's sort of like the dance of getting to know each other, doing diligence on each other, frankly, and sort of getting to that sort of decision point, and then getting them over the line, right? So that's sort of how I think about the process, not just for out-of-town investors, but in general. But again, I'll focus on the approach, is that sort of probably the most relevant to out-of-town investors specifically. And so there's a lot of debate, VC, Twitter, and elsewhere about sort of warm intro versus cold intro. Warm intros are still the most popular way to get in front of investors. So some people are more open to cold. They put their email on, out there. The DMs are open, but warm intros are still probably 80% of sort of how things sort of really get going. And VCs can use that as a screening tool, right? So it's evidence that you've shown some hustle, you've built the right network of other people, that are in the space. If I'm an AI investor and you don't know anyone that's an investor or an operator or service provider, or anyone that's interested in that space, and like our networks don't overlap at all, that's sort of a bit puzzling, especially if you're sort of thinking on a local or regional basis, right? Eventually your network should overlap. And that it just accelerates trust. It does create some network bias, and so that's why some people are now sort of pushing back on that and opening up the sort of the funnel a little bit more. But it does help people sort of navigate things here. So, don't be transactional. If you do find a mutual contact through LinkedIn, or you talk to a founder and they're like, oh, one of our investors might be interested, don't just like hit them up, be like, can I get an intro to so-and-so? You've got to build a relationship. You've got to sort of give to get, I think. But I do think this is still the rules of the field. And so there's actually some cognitive biases here that, probably play a part in this. And so just use them to your advantage. People, make the introduction, a bit of their social capital sort of rubs off on you. So, if people think highly of a founder, they're going to think highly of the referral, and they're going to pay attention to that, because otherwise, if they drop the ball, it makes them look bad in front of the person which they, think highly of. Just, use that to your advantage. This doesn't mean this is the only way to get in front of people. Another thing that's happened to me is perhaps the first intro got lost in the inbox, or I just was busy, didn't get back to it. But I got a second or a third introduction to the same founder. And then I'm like, wow, okay, my network is telling me that this person is a fit. I should be paying attention to this. And so that'll probably get you the first meeting, just because so many people think it's a fit. So use these things to your advantage. Just be cognizant of them. And the other thing, between pitch events, networking events, conferences, competitions, social media, people keep seeing that your company come up again and again. Eventually they're going to be like, this might be something worth digging in on. So a VC's surface area to sort of break in is pretty large. If you're talking to coastal investors, some of them will have relationships with folks in the Midwest or flyover country. They're going to have portfolio companies here. Regional investors will have portfolio companies all over the place. They'll have spoken to many more founders that perhaps they didn't invest in, but are still sort of connected on LinkedIn, are still a reasonably warm introduction. Service providers, again, limited partners who are the folks investing in the VC funds themselves. Again, there's a lot of ways to get into the network. So it's a little bit of a barrier, but it shouldn't be too big a barrier, especially if there's anyone that you think will be a really good fit. And just think about, are they, who are they? Are they a sector specialist that only does pre-seed or seed? Are they a generalist? Are they a specialist that only does, AI or fintech? And sort of plan the attack accordingly, and think, who would be sort of the best way in. Now, as I said, it's not the only way in. So if you're going to do a cold outreach, don't do what I see too many of still, which is a mass blast, a mail merged email where it's sort of dear first name, very generic email, because I know you've sent that to 1,000 people, and it's low signal, it's low intent. If you have gone through and you've actually sort of named me or someone on my team personally, that we're interested in a certain thing because you saw us at an event, or you saw us tweeting about something, or saw us writing about something, or we've invested in something already. That's great, because you've done a bit of work on me. So now I'm going to sort of pay a little bit more attention to, you truly thought this was a good fit. So now I'm going to, give a good, going to open the pitch deck for one and think, okay, they thought this was a good fit. Why, is this a good fit or not? Again, the fund name, why them specifically? People reach out to me with all sorts of random stuff, which if they went on the website would know that it's not a fit. So that's an immediate pass. And that's not a pass where I'm going to forward it on to someone, because there was just no intent. It was just a spammy blast, okay? You really want the cold outreach to be concise. Don't send sort of 2 or 3 pages of text. People aren't going to read it. You just got to make it compelling enough for them to open the pitch deck, which to me is like your number one sales tool. You'll be talking to it on the phone sometimes. It'll be standalone read. and it'll be the thing that's filed away and sort of referred back to sort of see where you were. So don't include vanity metrics. If you won an award that means a lot in your local market, that's good. You can include it as some signal, but really show that you are executing, show that you have early signals of product market fit, or if you're further along, some good signals of product market fit. Include that in that teaser, because again, you're trying to set yourself apart from everyone else that's coming out, all the noise that's coming at the investors. Do follow up. Some people don't want to. Again, inboxes get busy, so follow up. If don't hear back after the third time, then just move on. Eventually, perhaps someone will get back to you, but don't be ashamed to do that. And sometimes I get people not wanting to reach out because they don't have someone's email address. But the reality is they're all pretty easily guessable. Those ones across the top there probably account for 90-95% of all VC emails. So try the one on the left. That doesn't work, try the second one, and you can really sort of work it that way. The other way of approaching people other than email, and Amanda earlier was talking about sort of how social media has sort of shrunk the world. We're all at home, we're all engaging online right now. People have their DMs open on Twitter. You can be following, liking, replying. People will start to notice you and perhaps reach out to you directly, or you've at least created some sort of relationship there where people will respond to your DM. LinkedIn messaging is fine. Again, events and networking is still happening with COVID, but virtual actually is great because now everyone from all over can be there without any barriers. Some people are doing office hours again to sort of reduce that the warm intro barrier. I'd say the very last thing you should do is the contact us form on the website, because that's very, very sort of noisy. You get a dozen emails a day through that sometimes, and it's just not the sort of the strongest way in. So that can be your last resort. And then on the outbound side, this is VCs who are sort of doing an outbound strategy. Again, if you are talking at events, if you're showing up at events, if you put out a press release that now is keyword searchable, and you get picked up by PitchBook and Crunchbase, then people can sort of start to find you as their sort of which is obviously the dream, right? Rather than you trying to chase down people, you receive an email from someone interested in learning more. So these are all the different sort of tools you can use. Depending on who you are, where you are, what space you're in, there's not one best way of doing it, but I'd say try and go the warm intro route if you can, and if not, then try some of these other ones. I'll skip over this just given time, but this is just some examples across our portfolio companies, just all the different ways that people landed in our funnel. Obviously investor referrals have been a big part of it. Not the only part. We've gone to industry conferences where we sort of bumped into people at the startup alley kind of thing, where everyone's just sort of exhibiting. Bumped into people at sort of happy hour networking type things as well. So there's not one consistent way that people sort of get in the funnel. So just try different approaches with different people, and think about who's going to be the best fit. And so people often talk about the Midwest or the middle of the country differently to the coasts, and there's a lot of cachet with getting coastal investment. Really, it's the same. It's the same thing as what I just talked about, but it's different in a few ways. So one, there's a lot more funds. There's bigger funds, bigger checks, but also a lot more startups, and so there's a lot more noise and a lot of competition for attention. So you just again have to put your best foot forward. It's very competitive, right? So you got to really look compelling, be compelling, consistently execute to be compelling. They're gonna have different networks, so you might have a really good network in the town you're in, perhaps starting to get good regionally, but you need to focus on sort of getting into other people's networks, perhaps across the sector in these markets, because that's going to sort of really unlock some doors for you when you sort of want to cash that in. The different fund size is going to lead to different criteria as well. So even though someone might have invested in your space, their minimum check might be $5 million, and your round might only be $1 or $2 million in the Midwest, because that's all you need to get going. Our cost of operations are lower at that stage, and so you just got to sort of figure out, are you going to be not just a good I think I'm interested in what you're working on, but is the stage right? Is the round size going to be a fit for them? Like, is it going to be a fit for their fund model? At the end of the day, there's still just people. Everything I talked about still applies to them. It's just the more prestigious the firm, it's going to be just a little bit harder to get in front of them because everyone's sort of trying to get in front of them. So really, understanding geographic fit is going to be an important part of just filtering through people. So people might say they invest nationally, but if 95% of their deals are in San Francisco, Silicon Valley, perhaps not as active elsewhere, or you might find that the 5% is all sort of Series A sort of based. So just think about that. Think about how your net reputation, perhaps locally, does not necessarily translate to them, and just think through the challenges, and use Zoom, use these things you can do now to sort of really shrink the gap. I'll just skip over these last couple of slides here. So one is just this is all applicable to any fundraise, not just from out-of-town investors, but try and build conviction over time. Be transparent, be communicative. It'll go a long way, and try and assess how interested they are over time, so you can figure out the probability of them converting. The diligence process here, there's not one typical diligence process, but again, you can sort of really understand your relative strengths and weaknesses and how that lines up with the fund's priorities and their process, and understand that up front. Really try and drive them from being interested to a soft commitment, ultimately to a hard commitment. Try and be oversubscribed. Keep eliminating outstanding reservations. Try and really drive to a close. If you just keep dragging on and keep taking little checks as they come, it's not going to sort of pan out the same way. And last thought, because I think I'm out of time, but the out-of-town fundraising, is that sort of already talking about it? It's all about reducing that social distance. Building the network, your network, being thoughtful about that, using technology, using social media. The world has shrunk, and COVID, I think, has actually helped this. So use that to your advantage. If you want to see the longer version of this, if you follow bit.ly/TCSW fundraising best practices, that'll take you to a sort of 50-minute version of this. And thanks for having me.
Thanks, Jonathan. Really appreciate it. I would say that thinking about everything you just talked about, it is embodied in the Midwest.tech event that you just put on, and kind of coming full circle. I think we first met you at an event way back when, and just like you said early on, as much as we would have liked to, we would have had you close on a round right then and there at the event. But like you said, it's always while you're trying to always be closing, it's the closes to the next meeting, and hopefully you can get someone like we did with you to land on an investment and work together. And I think that just thinking about that entire process, it is embodied in what you talked about at Midwest Tech, manufacturing serendipity. I didn't know you were going to be at the event. I mean, maybe you did, maybe we didn't, but there was just a click on both sides. We continued to foster that, and we moved on to the next steps and continued that process. So
just
I really
appreciate it. And telling people what you're doing. I think it's the more people that know what you're doing, the more people that might mention you in conversation, that just good things tend to happen. So I appreciate that.
Absolutely. Thanks, Jonathan. Really appreciate it.
Thank you.
Looking forward to dissecting that more. But